Home prices in Toronto may have dropped 20%, but in this Canadian city, they've doubled and they're still increasing. Hey there, and welcome back to Prairie Real Estate. My name is Matthew Pfeiffer, real estate agent in Regina, Saskatchewan. That's my trusted assistant, Matilda. This is the weekly news recap, going through what I think are some interesting news articles, giving you my thoughts and opinions on them. But of course, let's start off with another one of my terrible bad dad jokes. What did the janitor say when he jumped out of the closet? Supplies! If you have a terrible joke I can use in a future episode, put it in the comments below. Let's quickly look at the CMHC housing starts. In my 2024 predictions video, I said that housing starts would be down. I was wrong. They actually increased by a grand total of 5,000 units in 2024. The large majority of those are purpose-built rentals. There's a ton of incentives through the government CMHC to get those built. So not very many of them are actually single family or townhouses that you want to buy to live in. There were 228,000 starts in 2024. That's still nowhere near the number of homes we need to be building. I will be talking about that in just 1 second. CMHC's seasonally adjusted numbers are actually down 14%, meaning fewer homes got built. Multifamily home starts are down 15% and single family home starts are down 10%. Okay, hold up, time out. Now for the stats for a second here. If you're thinking about buying a house, of course, if you're in Regina or moving to Regina, I'd be extremely happy to help you out. But don't worry, if you're somewhere else in Canada, I can still help you out. I've got a great network of agents across the entire country. If you look in the description of this video, you can book me in for a consultation. I'll phone you, learn about what's important to you to buying a house, and get you set up with one of those perfect agents. Now back to the video. Now let's talk about how we need 500,000 fewer homes by 2035. This report is from Oxford Economics, and in the past I've found their track record, especially on their forecasts, to be a little bit spotty. But they're saying based on the Government of Canada's new projections for actual population decrease in Canada, that we will need 500,000 fewer homes to be built. This doesn't mean that we now have an excess of 500,000 homes in Canada. It means that instead of needing 4.2 million homes to be built by 2035, we now only need 3.7 million built. The government has continued to maintain that they're going to get like 3.5 million homes built by 2030, so they'd actually hit the target that Oxford Economics says we need to hit about 5 years earlier. As I just said, last year, 240,000 homes built in the year. So if we were to continue that pace, we would still fall short by nearly 1 million homes by 2030. And the most frustrating thing about this is when we're tracking housing starts and completions and everything else, is we're not taking into account what type of homes are being built. In this case, a unit is a unit is a unit. A dog crate condo counts as one, and a 5,000 square foot, 10-bedroom house also counts as one home. I think we need to have a better way of tracking this where we're looking at the types of homes built and what types of homes need to be built, not just total number of units. Let's look at the stats. Canada recently released inflation data. The headline number is that inflation increased only 1.8%. We should be all excited. Things only got 2% more expensive. What else isn't really mentioned in the headlines is that the majority of this lower inflation is due to the Government of Canada's GST holiday, which we, at the time of this data, were 1 month into. Without the GST holiday, the inflation rate would have actually been about 2.3%. The inflation did drop from the previous month's 1.9 down to 1.8%, again, mainly due to that GST holiday. It puts it within the Bank of Canada's target range of 1 to 3%, and it's been within that range essentially now for almost a year. But the Bank of Canada's favorite core metrics, which strip out some of the volatility out of the CPI basket, that was actually at 2.4%. It was down from 2.6, but it's kind of hovered around that 2.5% mark for a number of months in a row now. I think better part of a year, actually. The expectation of the Bank of Canada is most likely on January 29th that we will see them cut by 0.25%. I talked about this in my 2025 predictions video. Keen-eyed viewer also noticed that I actually said January 24th instead of January 29th. Funny story, I put it in the comment response. I actually remembered basically in the middle of the night, I said the 24th instead of 29th, and I got to change that. I fell asleep and forgot to change it, so it actually says 24th on that video. This next section is called Matilda's Questions. It's going to be me answering questions that you have given me from the comments. So if you have a question you want answered in next week's video, put that one in the comments below.
What's the difference between average price, median price, and the Canadian Real Estate Association's benchmark price.
This is a really good question because when you look at different forecasts, like in my predictions video, most of them talk about average price, except if you're Royal page, then you use your own internal benchmark price, not even the Canadian Real Estate Association's benchmark price. And that's a whole thing I'm not going to get into here. The way you calculate average price is taking the total dollar value of all the sales in that particular period divided by the number of sales. The problem becomes, especially if you have a smaller sample size, is the volatility. You get a couple of really high sale prices, it's going to skew that up and the same thing down. When I do my monthly market updates, every time I talk about benchmark price, except for Halifax, because they don't have benchmark price there, and you can see when you look at the price chart, it tends to swing up and down a fair bit. You get swings of $20,000 in a month. No, that doesn't mean home prices change $20,000 a month. It was just because of the composition of sales. Median price is also fairly simple to calculate, and the way that's done is you just take the total number of sales and split it right down the middle, meaning half of the homes sold for more than that value and half sold for less. Then you have the home price index, otherwise known as benchmark price. It's what I use in my monthly market updates. This was created by the Canadian Real Estate Association, and essentially they're creating a fictitious house and tracking price fluctuation of that fictitious home based on what they feel the most commonly preferred criteria for the different property types. So you have apartment, townhouse, single family, single story, single family, two story. Those are the different calculations that they do, and then they have an aggregate combining those all together. I use the aggregate when I talk about the different cities. This is by no means perfect and it has its flaws. You can argue what criteria should be put into it. I will link in the description below how they come about their calculations. You can go dive into it if you want. I find it to be a little bit slow to react, kind of a lagging indicator. The Canadian Real Estate Association is working on improving that. Every May, they kind of rejig the criteria to try to make it more accurate and representative of what's going on in the market. Personally, I find what I see with prices going on in my market, the Canadian benchmark price tends to be fairly representative of that, and that's why I use it. Let's get you up to speed on the best mortgage interest rates in Canada. There was a little bit of movement in interest rates this week, and not in the types of products that you would expect it to change. Starting off with insured mortgages, the best 3-year through Radius, 4.34, that was unchanged. The best 5-year was 4.29, also through Radius, unchanged. Looking at 5-year variables, the best static variable was 4.8% through Manulife, that went up. And the best adjustable, 4.55 through Marathon, that also went up. Now let's look at uninsurable mortgages. The best 3-year, 4.74 through Scotiabank, unchanged. The best 5-year, 4.79 through MCAP, that went up. Looking at the 5-year variables, the best static variable was through Scotiabank, 4.9%, and the best adjustable, 4.8% through B2B Bank, that is up a little bit. Looking at the big 5 banks' best 5-year fixed insurable mortgages, here's what we got. In first place, Bank of Montreal, 4.45%, unchanged. Second place, CIBC, 4.59%, unchanged. RBC comes in at third, 4.59%, unchanged. Scotiabank at fourth, 4.69%, unchanged. And TD Bank comes in at fifth place, 4.79%. That is a drop from last week. When you see variable rates changing outside of the Bank of Canada's rate announcement changes, that's because discounts the different lenders are offering are either applied or removed, and that's what happened in this week's case. Looking at the 5-year Canada bond rate, it started the week at 3%, and as of the time of recording on Thursday night, it's still at 3%. Looking back to last year, we saw that bond rate peak up at about 3.8% in May, then it dropped all the way down to 2.9% in August. It dropped again to about 2.6% in September very shortly, and then picked back up. But essentially, since August, it's been hovering around 3%. How about a Calgary area city that has seen home prices double since 2020? Kind of the big story all through 2023 and into 2024 was how hot the Calgary real estate market was. I talk about it every month in my monthly market update, which if you haven't checked it out, I'll put a link to that in the description below and a pop-up card from my most recent video. Let's talk a little bit about the commuter towns around Calgary, because they, in some cases, have been hotter than the city of Calgary itself. And this article specifically is talking about detached homes and how much they have increased in the town of Strathmore. Now, the city of Strathmore is mostly just single family homes, so looking at detached here is fairly representative of the entire city itself as well. Since 2020, the price of a detached home in Strathmore has increased 56%. But wait, you said they doubled. 56% isn't double, right? Whenever you look at real estate reports, mine included, and they talk about how much prices have changed, they're talking percent difference. It's a little bit quirky. I'll link if you want how you actually calculate percent difference. So No, 100% is not actually double in this case here. 56% works out to basically double. Back in 2020, the price of a detached home in Strathmore was around $360,000, and today it's $540,000. That's how they get almost double in this article. Looking at this map here, again, this is just detached homes for Calgary and the surrounding area. You can see how hot that single family market still is. Calgary, 1.5 months in inventory, and a bunch of those surrounding towns in that same Okotoks there, 1.3%. So in general, detached homes in Calgary, still a very, very hot market. That wraps up this week's news. If you have questions on the answer next week's video, please put them in the comments below. Here's my 2025 predictions video if you haven't watched that. And as always, thanks very much for watching.